Thank you. Hey, Josh. All right, folks. My apologies there. I simply missed the time. I was feeling a little sick, so decided to relax a bit, and I missed the time. Anyway, now that we're here again, folks, thank you for joining this class. This is Mark de La Paz. Now, it's a bit unusual for us to have our ECB rate announcement, rate decision on a Wednesday. So let's just let me just fix my screens up. All right, guys. So let's get started then. Hi, FX, Rodan. So, guys, where should we go? What should we look at? What is happening? Everybody's big story is about the U.S. and the ECB's decision today has been seen more of as a sideshow. I was reading a report earlier that, well, not really a report, but an opinion piece, one from George Soros. And apparently, Mr. Soros is saying that, hey, look, the ECB, rather the Eurozone's already through its own, is already through with the crisis. He was suggesting that the problem, though, right now for the Eurozone is that even though the area is already through the crisis, there's, or rather, the tenor of how the Eurozone area works has changed. Okay, he says that it has changed because the EU has basically been split into countries of haves and those on the one hand, and the have-not countries on the other, and that because of this, the equality that was ingrained in the EU before is slowly eroding. You know what? I don't really care if there is this change in how the countries treat each other. What matters for us is the assessment that the EU is out of its crisis already. Do we really believe that? We've had some good data lately from the Eurozone and from the member countries. But the unemployment picture, the unemployment levels remain pretty high. So I don't quite buy the notion that we are already through with the crisis in the euro area. We have gone through the worst of it. We have started growing again, but by all means, we are still far from the point where we could say, this is where we were. We are now back to square one. Okay, so we haven't really recovered what was lost over the last couple of years just yet. Does it matter for this ECB decision where we are? Not necessarily. What are the expectations for this ECB decision? We're not really likely to get any big announcements from the ECB. This is one of those ECB decisions that is more of a secondary story. The fact that we've had good numbers lately, the economy is starting to grow, does indicate that we may see some new guidance coming out of Mario Draghi. But from what we have seen from him before, he's not likely to go out there and trumpet crisis over. Okay, from what we have seen of Mario Draghi before, he will likely be cautiously optimistic. about how, well, FX Redan, that's actually good that we do have a low inflation situation already. At least he's not going to get a lot of complaints from the Bundesbank president when the governing council meets, because that's been one of the key issue that you're going to have inflationary pressures. So, oh, by the way, another issue, of course, that, okay, let me get back to that. So, as far as our rate decision is concerned, we expect nothing. This is something that we could sleep through. What matters will be the press conference that follows, about 45 minutes after. What are the issues that Mr. Draghi would be tackling? For one, although the shutdown in the U.S. government and the prospects of no consensus and the prospect that by the 17th of October, you're going to see some form of default, since the Republicans appear hell-bent not to pass legislation for the budget, not to pass legislation to increase the debt ceiling. That is something that is of concern as well for Mr. Draghi. Why would U.S. policy be a concern for the ECB? Simply put, if the U.S. fails to increase its debt ceiling, there's going to be a default. If there's going to be a default, what do you think would happen? Some people are saying that a default by the U.S. government would be similar in nature to the 2007 crisis. Why is it? And from the ECB perspective, what would it mean for them? Well, guys, for one, as far as the ECB is concerned, if indeed there's a default by the U.S. government, it may make Eurozone debt more attractive. Okay, remember that people out there are looking for safety, and for so long, for half a century, the U.S. Treasury was considered to be the safest financial instrument out there. Why was this? Because the U.S. has never had a history of defaulting. It's ingrained into U.S. law. It's in the Constitution that it will pay its debt. But without an increase in the debt ceiling, there will simply just be no cash. Now, from the perspective of the ECB, what would be the impact of this? It rattles the markets. It might freeze lending. Okay? So, one impact would be, it would make euro-denominated debt potentially attractive, especially your German bonds. The bonds would be very attractive. They would be considered safe. They don't have as long a history as the U.S. Treasuries, but that would still be a good option. However, the size of that market isn't really a match to the size of U.S. Treasuries. So you'll have people looking for other bonds out there that they could look at and they could say safe. So there will be pressure for the euro to strengthen, given this likely abandonment of U.S. Treasuries. And we want to hear from Mr. Draghi what kind of preparations is the ECB doing. Is that threat of this happening, preventing the ECB from doing its own refinancing operation. Okay. What else? Consequence of this from the commercial end would be, all right, if U.S. Treasuries would not be deemed the safety haven that they were, and people will be looking for other currencies or other bonds, other government debt for a potential haven, then might not the banks also think, hey, if this is happening and you have a bank out there that holds a lot of U.S. Treasuries, what do you think would happen if the U.S. government defaults and a bank is holding a lot of U.S. Treasuries and it needs money? So it opens the possibility of a freeze in lending in the financial system. If my main, or rather, if the main asset that the banks are holding suddenly is found worthless, well, not really worthless, but will be found to have lost a lot of its value because of a default, then banks would start asking the question, why would I deal with you? Why would I give you this much credit limit? Why would I give you this much margin when you trade with me, when you do deals with me, when I don't really know how much U.S. Treasuries you're holding in your vault? And that could really have some ugly implications for us. Well, that's exactly FX Ridam. But my main concern here is what kind of preparations would the ECB have once the banks begin to question the viability of each other, once they begin to question what's in the balance sheet of their counterparties. Just remember, U.S. Treasuries being the safest treasuries, being the safest bonds around, is held by a lot of banks. Okay? If a bank has extra cash and they don't have anything else to put it on, they put it in treasuries just to make a little something out of it. So that's your big question mark. So if the banks stop lending to each other, what do you think would happen to lending between banks and their customers? Okay, so that is really the bigger threat, the bigger story right now out there. And as far as the ECB is concerned, or as far as the press conference later is concerned, that is what we'd like to hear. What is the ECB doing in order to counter this? Would it actually be willing to take on the role that currently is held by the Fed? Would it actually be willing to say, okay, banks, here you go, here's €1 billion. Well, $1 billion is not that really a lot of money. So here's 50 billion euros, 100 billion euros. Go lend to each other. And of course, if the ECB were to do that just to shore up its own banking system on a default by the US, what would be the impact for the currency markets? Okay? If the ECB decides to release that kind of amount, that kind of money, impact for the currency markets would be you flood something, you increase the supply of something, you decrease the value of that something. So what I'm saying is it would lead to a lot of volatility. So the key date for us is if by the 17th there is still no operations of the US government, then likely there's no increase in your debt ceiling. Without an increase in the debt ceiling, you might just get some wild swings out there. So we'd like to hear Mr. Draghi confirming that this is such a possibility, this is such a scenario, and that they are prepared to step in to shore up the European banking system. Stepping in meaning they're prepared to flood the market with money, the way the Fed has been doing for the U.S. Okay, so if we hear that, net impact for us would be, I'm not really sure why someone would price in that situation this early when there are so many variables that could happen. But this kind of event is something that ought to lead to a weaker euro. If we can confirm that there are preparations being made for the ECB to take on that role of shoring up the European banking system the way the Fed has been doing in the US, the way the Fed did back in 2007 when Lehman Brothers collapsed and the banks started to distrust each other. Okay, so that's the main issue. Now, like we said, we don't expect anything from this rate decision. But how do we deal with the euro? Let's just take a look at the chart for this point and let us see what is it that we can do with our euro. Oh, by the way, folks, if there's anything that you'd like to ask, feel free to raise it, feel free to tell me about it. So what's going on? I'm looking at my chart for euro and I find that we remain stuck in a tight range for today. Your euro has been playing a congestion for the last 2 weeks. It's played a congestion for the last 2 weeks and you have a tight range for today. So far you've had only half the average range. You've had 32 pips of price action. That's not even half the average daily range. How are we supposed to plan or how are we supposed to react to this? Well, guys, like we said earlier, if we hear that there are preparations, then to me, the possibility of added money, of freshly minted money, would be a good excuse to follow through your reversal of your breakout yesterday. In the end, remember that you had that very long wick in your daily chart that pushed back into the previous range play. And that to me suggests that we really ought to be looking for a test of your congestion floors around your 34.63 area. If I look at our numbers, projected low for euros of about 34.71. So we just need that catalyst. We just need that story about preparing to flood the market when necessary on the 17th to get things going. Oh, by the way, to make things even crazier, let me just go to the FX Street website. Let me just show you something. To make things crazier, folks, we actually will be seeing ADP employment change data 15 minutes before the start of Mr. Draghi's speech. Why am I saying to make things crazier? Let me put it this way. With the government shutdown in the US, it's highly likely that NFT will be postponed. There are just no number crunchers working. The military is working, The police are working, the border patrols are working, but the guys at the Bureau of Labor and Statistics are not. So we may not have an NFP announcement, and if there's no NFP announcement, that would just double the importance of your ADP employment change data later. And why am I saying that this could make things crazier for us? Well, if that's the only jobs number that will be released from the US this week, then a lot of your frustrated traders would probably focus on it. And then 15 minutes after that, you've got people shifting their focus, shifting their attention to what Mario Draghi would be saying during the press conference. So there's a lot of reason for us to expect volatility. Mario Draghi alone, I would expect volatility from, and now we have an increased importance to today's employment change data. I'm even thinking, is it really that important to have our NFPs? Do they even have meaning? Because the US government just, I won't say laid off. People were just put into unpaid vacation, unpaid leave, until government gets legislation for its operations, for its budget. Excuse me. So expect plenty of whipsawish action. In the end, though, if you're like me, looking for a weaker euro, what we want to hear is the willingness of the ECB to step in, provide liquidity in case there's a freeze in the financial system brought about by the potential for a default by the US government. Okay, so if the US stops paying those bond coupons, then we expect the banks to stop trusting each other, and we need someone to step in, provide the liquidity, say, continue those transactions. Will the ECB take that role? Excuse me. If we hear that, that becomes an excuse for us to test our congestion floor, potentially push below it. And honestly, when I look at our Euro chart from the big picture, I really tend to think Euro is pretty expensive right now at the moment. Look at where you are. Look at where you were from last year. All right, folks, let me just go through our charts and let me see what could be interesting with respect to this press conference. We find ourselves with the currencies and the equity markets basically going the separate ways. Our correlations are just not working. Why do I say this? Well, we've sold off in our equity indices yesterday when we've had a bounce in our equities. Now, today, we have a poor open from European equities. But guess what? those European equities have already recovered. We are close to closing the gap that we've had from the open of European equity markets. But when you look at your yen pairs, they're still down. They haven't moved an inch. They haven't tried to bounce back up the way we've done in our equity indices. So what does that mean for me? It looks like a lot of people in the currencies are really just feeling risk averse at the moment. And what does that mean for us? Oh, by the way, guys, as expected, nothing happened with your interest rate decision. Let me just put it this way. If we're expecting that there will be talk about flooding or the ECB stepping in, being ready to shore up the banking system in Europe in case the U.S. politicking really worsens and nothing gets done by the 17th, then I'm thinking, okay, that's an excuse for you to look for the euro to ease off. And with our yen already strengthening, wouldn't your euro yen be a good candidate for potential trades? So let us see our EUR JPY. And what have we? Unfortunately, we are needing average range for euro yen. But if you have news, if you have catalyst, forget about your ADRs. The average daily range is good when you do not have catalyst to really push the market. But once you have catalyst, once you have news, once you have an event that could move things, you throw away notions of following the ADR and just look at the possibilities. And what are the possibilities for us? I'm looking at my chart and I'm thinking we are right around 50-50 retracement. Yes, we have seen ADR, but if we hear that the ECB is willing to step in, provide liquidity, that becomes a good excuse to think in terms of pushing through your EMA lines. It becomes a good excuse to try to make a run for your 3100 area. ALV, yeah, thank you for that. Like I said, not really an issue for the markets. So guys, what am I suggesting? I'm suggesting that depending on the tenor of the press conference, we would want to look at the possibility of going beyond your average changes, of pushing below our 3164 area, trying to make a run for the 3100 price point. Again, technically, we find ourselves looking for follow-through weakness. Indicator-wise, yes, you look mixed, but the MACDs are down. You've tried pushing oversold before. As far as ADRs are concerned, yes, we are near average changes, but as we mentioned, if news is involved, if potential policy changes is involved, we go beyond your average ranges. So things that I would look for. What would be mentioned by Mario Draghi? His willingness to intervene in the banking system. Now, by the way, it's not easy for Mario Draghi to do this. unlike the Fed, he's really constrained in just how much he can make this move. Remember that Europe still has to really create a centralized banking regulator. And Mario Draghi's role in this right now is no one else has that job. And if I'm going to take care of the monetary system, I might as well do this, but I don't really have the authority, or at least the written authority, to do this move. So it would really be a big deal if the ECB were to emphasize its ability to take action to shore up the financial system in Europe if the US defaults. So guys, we're not in a position to do anything right now, but like I said, keep a close eye of that 3164 area. A push through it we could use as an excuse for jumping short. We could look for 131 as our objective, possibly go beyond that. I wouldn't discount the possibility of another 100 pips, get to 3062, 61 of retracement, depending on just how ready the ECB is going to be to flood the markets with money in case of a default. Let me just go through some other charts. If you've got any questions in mind, guys, if you'd like us to look at anything else, just tell us about it and we'll have a look-see. If it's not that related to the ECB, I don't mind. Is the heat dollar CAD? Alrighty, let's take a look at that. You look at your chart, you've actually been pretty bullish in your dollar CAD. You have long tails in your daily charts. My only problem with this chart is you've got a very tight range. 44 pip average daily range. So pricing becomes a very important issue if you play this. That said, what are we facing? Daily charts were looking bullish. You're pushing for overbought territory in your stochastics and the dailies. You're trying to push through the EMA lines. We've managed to close above 38.2 fib. The fact that we closed above 38.2 fib yesterday and with our long daily tail tells us that it's okay to be overbought in stochastic. In fact, you should be looking for stochastic to push further into overbought area to underscore the ability of your dollar CAD to stay above your 38.2 fib level. You've only seen half the range of the day, half the average range so far. So our objective is to actually make a run for 103.80. And that's around or just above your 50 fib level. 50 fib is 103.75. You're faced with R1 as well at 103.56. So what am I suggesting? I'm suggesting that this could be a buy on a new high. Could this be a buy now? Ideally, I would want to buy from your pivot. Pivot is at 103.22. All right. I'm not likely to get my ideal condition, but we do have a nice congestion floor around that 103.38 area. and I'm just above that. Why don't I buy this at market? We can actually try that. Remember, you have a bullish daily bias. You're trying to get through the EMA lines. For our picture, you have a confluence of buys, although you have a loss of momentum. Hourly charts, for now, you have bearish signals. But as long as we're above 103.38, I should be fine. So I would view this as a possible buy. I won't jump in with a big trade. The way I treat this would be I would want to scale this. I would want to build into my position, have something around this area, and if I have a break of 103.56, then, oh, you're already long. Well, in that case, if you want to squeeze it, I'd say push above R1. You might want to add on to it. And like I said, our target is about 103.80. But if you think of this in terms of, I'd like to hold on to the trade for a couple of days, you might as well think about trying to make a run for the 104.44 level. Because that seems to be a pretty nice target. So I'd look at 103.80 as a possible target today. Afterwards, you have your 61.8 retracement, 104.20. And then you have this nice resistance at 104.44. Anyone who's long, I'll just suggest that you put a tail stop. Tail stop from just under your 103.39 price point. So maybe 103.35 would do for a tail stop for you. And then try to scale in some more at the break of 103.56. Sounds pretty good, Zaid. Good luck with that buy. Let me get back to overview, guys. One of the interesting things yesterday was gold. I really didn't have any trade there. I was just impressed with the way you sold off in gold. You sold off by more than 5,000 ticks, roughly on a single contract that's worth about $5,000. What happened? Well, according to reports, we basically had a major fund just closing its positions in gold. And now you've triggered a head and shoulder because of that big sell-off. And now our gold chart looks like it's a rejection from your EMA lines. And if I were to do fibs, it would look like a rejection from 38.2 fib retracement is continuing. And we are heading back down to your 118 area. And we ought to really be thinking in terms of, can we pull back? Oops. Can we pull back to these levels around your 1,000 region? Hey, Igor. Oh, that's for Zahid. Sorry. I thought you were sharing to all of us. Oh, was it? Yeah, Canadian dollar. Nice. You think that it would still ease down to 103.16 and then bounce off it. All right, guys. So where are we off to next? So far for the day, gold's actually been active already. You've had a decent range, about 1,900 ticks. But its average range is about 2,700 ticks. So we should still have some room to maneuver. Timing-wise, though, I'm not really keen about doing anything around this time of the day. I prefer taking my trades from about 0600 to 10 GMT when I've got liquidity backing me. Okay, any questions, comments, issues, complaints? So guys, my apologies for being late. Let me just show you one more chart, and then if there are no questions from anyone else, I'll leave it at that. What is that one more chart? Let me show you your Aussie. Aussie. Why Aussie? Because we pulled back today in Aussie. We have average daily range already in Aussie. And I'm thinking we're already building a base in Aussie. So one of the things that I'm working with is, could I use this base for another attempt at pushing higher? Remember that as far as the RBA is concerned, they've dropped the idea of being ready to cut rates. That's no longer there. They removed it in their rate statement. Data yesterday was bad, but overall data trend has been good. And the reason why the RBA before was on watch for cutting more rates was weakness in the Eurozone economy, weakness in China. Both of this are, well, they've been resolved as well. Okay, the Eurozone's already starting to grow. Chinese manufacturing is already back up. And policy changes in the fiscal side is also happening in Australia. So I just want to point this out because this is really, for me, a very big deal. You look at your Aussie chart and you've sold off by quite a lot this year. We've already bounced up a bit. We've already tested 38.2 fib. But what I'm saying is, well, you're coming off another fib area right now, and you're looking for the test of that 38.2 fib at 9,500, 9,510. And you actually had an inverted head and shoulder before. And the target of that is at 95.80, and you haven't gotten there yet. And you still have room to maneuver. Your pattern remains valid. The follow-through breakout remains valid. So I'm just saying, take a look at this. Possible buys of your 93.38 region. Comments, questions, complaints? Okay, folks, there being none. Again, my apologies for being late. Thank you for joining the class, and good luck with the rate decision.